Now speaking, Tyler Burns, Director, Investor Relations. Thank you for joining us today. Canopy Growth has released its financial results for the first quarter ending June 30, 2023. You can find the news release and financial statements on our website. Please note that our discussion will include forward-looking statements based on management's views and assumptions. Factors that could affect actual results are outlined in our reports filed with the SEC and on SEDAR. Now, let's hear from our CEO, David Klein. Now speaking, David Klein, Chief Executive Officer. Good afternoon, and thank you for joining us today to discuss Canopy Growth's first quarter results for fiscal 24. I'll cover 4 key topics: the progress of our transformation to a simplified asset-light business, the improved performance of our Canadian cannabis business, the strong top-line performance for BioSteel and Storz & Bickel, and a brief update on Canopy USA and the encouraging developments with our U.S. cannabis brands. We've made significant changes to our business, streamlining and simplifying it to become more competitive. This transformation has resulted in a 60% reduction in cultivation footprint and total headcount. Our remaining cultivation facilities in Ontario and British Columbia are producing high-quality flower, and our supply is effectively matched to demand. This transformation has delivered significant cost savings, with expenses reduced by $172 million to date, including $47 million in the first quarter of fiscal 24. We expect this transformation to yield $240 million to $310 million in cost savings by the end of fiscal 24. Our Canadian cannabis business delivered stable to growing revenues, increasing 12% sequentially to $24 million in the first quarter. The resurgence of our Tweed brand has led to strong demand across the country, elevating it to the number 8 rank within the total flower segment of the Canadian adult-use cannabis market. We've added Wana edibles to our Canadian portfolio, unifying our North American house of brands. We've developed a brand growth strategy for Wana, starting with the availability of Wana gummies for registered medical cannabis patients. We expect the addition of Wana to be accretive to revenue and adjusted EBITDA, cementing Canopy as Canada's leading cannabis edibles company. BioSteel delivered its 4th consecutive quarter of record revenues, increasing 68% sequentially. We're actively engaged in a strategic review of the business, including exploring a sale, to reduce the drag on our profitability and focus on our core cannabis businesses. Storz & Bickel saw a 16% year-over-year revenue growth in the first quarter. We're preparing to launch a new line of innovative vaporizers this fall, driving the next era of growth for the brand. Our U.S. cannabis businesses continue to drive brand growth, leveraging an asset-light expansion strategy. Jetty expanded its product offerings in California, and Wana products are now available in 15 active U.S. states or territories. We're also collaborating with TerrAscend to capitalize on the large market opportunity in the U.S. In summary, our Q1 earnings demonstrate that our transformation to a simplified asset-light model is already yielding results. Our core cannabis business is stabilizing and growing, and we have delivered significant cost savings. We remain focused on North American cannabis leadership and are exploring options to reduce cash burn associated with non-core assets. We're confident in the potential of the North American cannabis market and will continue to take actions to cement our transformation. Now speaking, Judy Hong, Chief Financial Officer. Good afternoon, everyone. I'll start by recapping our first quarter fiscal 2024 results. We delivered revenue growth and profitability improvement across our businesses, generating additional cost savings. Q1 net revenue was $109 million, up 3% compared to last year. Excluding retail divestiture, net revenue increased 16%. BioSteel saw revenue growth of 137% and Storz & Bickel grew sales by 16%. Q1 gross margin was 5%, excluding BioSteel it was 18%. Q1 adjusted EBITDA loss improved by over $20 million to $58 million. Free cash flow was an outflow of $151 million. In Canada, Q1 net revenue was $40 million, with adult use B2B down 9% YI but up 12% KIK. Canadian medical sales increased 7%. Rest of the world cannabis sales were down 26% YI but increased 16% KIK. Cannabis business delivered revenue of $50 million, gross margin of 18%, and estimated cash gross margin of 32% in Q1. Storz & Bickel saw sales grow 16% YI and gross margin improved to 43%. This Works grew sales 9% YI with a gross margin of 48%. BioSteel saw revenue growth of 137% to over $32 million in Q1. Gross margin was negative 24% due to higher costs, but we have implemented actions to reduce costs. Q1 adjusted EBITDA loss was $58 million, an improvement of over $20 million. Cash and short-term investment balance at June quarter end was $571 million. We settled $237 million of unsecured notes and reduced senior secured term loan principal by $93 million. We expect total debt balance to decline to approximately $570 million. Our key priorities and outlook for the balance of fiscal 24 include achieving profitability in Canada cannabis, continued growth in Australia and Poland, improved performance in Germany, and new product launches for stores and Bickle. We expect Q2 sales for BioSteel and this works to show more modest growth. We believe Q1 results demonstrate progress towards positive adjusted EBITDA and we're actively working to improve our balance sheet. TD Cowen analyst Vivian Azer inquired, could you please provide more details on the economics of the Wana distribution agreement and how it compares to CPG margins? Additionally, how do you prioritize Wana within your total portfolio and what is your perspective on the risk brought by the master brand approach? David Klein replied, Wana currently holds a 13% share of the edibles market in Canada. With our distribution efforts, we believe we can increase that share significantly. As the brand owner, we will benefit from the entire margin, including distribution and brand ownership economics. While we do have manufacturing costs with our CMO partner, we expect this expansion to be accretive in terms of growth, EBITDA, and margin. Additionally, adding Wana to our portfolio provides a positive financial impact. In Canada, we have focused on revitalizing the Tweed brand, which is already well known in the market. We have improved the quality and have seen strong growth with certain strains. We will apply this approach to our Doja and 7 Acres brands in the flower space. In the beverage segment, we continue to drive Tweed and Deep Space's strong brands. Having Wana in key markets like Toronto, Montreal, Vancouver, as well as Surterra markets in Florida and Colorado, helps establish it as a North American brand. While we don't disclose specific financials for Wana, it is a profitable business with a strong presence in key markets across the U.S. We aim to revitalize its presence in Canada. Judy Hong replied, in terms of our financial performance in Canada, our goal has always been to achieve profitability at the current level of revenue. We have previously stated that reaching $35 million to $40 million in revenue would allow us to achieve profitability, and for the past 3 quarters, we have consistently been within that range. With the addition of Wana to our portfolio, there is potential for further upside in revenue and profitability in our Canadian business. We will provide more information on the revenue and profit potential of the brand once it is fully integrated into the Canopy system in Canada. Alliance Global Partners analyst Aaron Gray inquired, can you discuss the potential for reinvigorated patient growth in Germany and how your company plans to take advantage of the opportunities in that market? David Klein replied, we have obtained regulatory clearance for our strain offerings in Germany and have expanded our GMP production capacity in Canada. We have also bolstered our sales team in Germany to effectively address that market. We are optimistic about the growth potential in Australia and Poland, and we believe we can achieve good growth in the German market as well. Our international business performance is strong, although it may appear slightly muted compared to last year due to a one-off sale to Israel. Overall, we are bullish on the international markets. Piper Sandler analyst Michael Lavery inquired, can you provide an update on the status of BioSteel and whether you have found a suitable buyer for it? Additionally, can you give us a rough timeline for when this transaction might occur and how it will impact the company's trajectory for the rest of the year and into 2025? David Klein replied, we recognize the value and appeal of the BioSteel brand to consumers, but as we focus on the cannabis industry and its significant market potential, it has become clear that BioSteel may not align with our cannabis-focused portfolio. Therefore, we are actively working with our board and the BioSteel team to minimize the impact on our EBITDA and cash flow. We are committed to addressing this issue swiftly and effectively. CIBC World Markets analyst John Zamparo inquired, my question is regarding the cost reduction plan. What factors will determine whether the company achieves the lower end of the $240 million range or the higher end of $310 million? Additionally, does this range include remediation efforts on the BioSteel brand, or should those be considered separate? Judy Hong replied, the cost reduction plan primarily focuses on our Canada transformation plan and overall organizational streamlining efforts. We have already achieved significant cost savings year to date and from fiscal 23. We have a remaining cost reduction program to reach our target range of $240 million to $310 million. The range is wider due to the ongoing execution of the second phase of our cost reduction program, which includes the full exit of the One Hershey campus. We have successfully transitioned production to the old beverage facility, resulting in savings on manufacturing and indirect costs. While we have a good understanding of where the cost reductions are coming from, we will provide more details as we gain full P&L visibility in the coming months. Canaccord Genuity analyst Yun Kang inquired, could you please provide more details on the quarterly adjusted EBITDA loss amount for the current quarter and how we should consider the contributions from each segment for the rest of the year? Judy Hong replied, in Q1, our adjusted EBITDA loss was approximately $58 million, with around 60% of that loss attributed to BioSteel. If we remove BioSteel's loss from the equation, the adjusted EBITDA loss would be around $25 million. We anticipate cost savings of approximately $100 million, which will help bridge this $25 million loss to our expectation of achieving break-even to positive adjusted EBITDA by the end of FY24. David Klein replied, thank you for your interest in our company and for joining us today. Our innovative brands offer outstanding products that I encourage you to try. If you have any additional questions, our investor relations team is available to assist you. Have a great evening.